Hello and welcome everybody. Happy Friday. Hope everyone has a lovely or had a lovely week, is ready for a lovely weekend. Funny enough, it is raining here in usually sunny Southern California. It's kind of nice to have a little bit of a different type of weather, also water all the plants. Anyway, I'm here with you all ready for another webinar where we have an awesome topic today. This week marked the beginning of spring, or not spring, funny enough, fall, winter, fall. Fall? We're in fall now, right?
Fall.
I'm terrible with calendar seasons, which is why today we're going to talk about fiscal seasons instead. Companies have to follow, just like the calendar does, certain seasons coming and going every 3 months. And not like the weather, they have to give us a report about what that season provided. So today I want to talk about that. I want to talk about what earnings season is, what the earnings calendar is, what earnings are, and most importantly, why they matter to us as investors. So, without further ado, I want to say hello to everyone we have with us before we get straight into today's webinar. As always, these webinars are recorded live every Friday at 4 p.m. Los Angeles time, 7 p.m. New York time. If you're ever available, feel free to come join us and say hi. So, hello to Euro, Elizabeth, Fernanda, Graciela, Rita, Emelida, Veronica, Blaze, Ermila, Kira, Yesenia, Chela, Blanca, Lucia Sotero, my mother, Patricia, Lupe, Danny, Gloria, Maria, Eddie, Andrew, Nidia, Iwumi, that's a new name. Welcome to our webinars. Sarah, and many more. Great to see you all. Let's get straight into today's action, where we're going to be talking today about earnings. Quick disclaimer, as per usual, information today is all for educational purposes only. Past results can never guarantee future performance, so please always do your own research prior to making any investment decisions. So, what are earnings? Earnings are a short way of saying earnings reports, or sometimes they're also called earnings calls. These are reports that are provided to investors and the SEC, the Securities and Exchange Commission, 4 times every year by a company. These earnings calls are a way for the company to share details about different financial numbers, the company's performance, and in certain reports, even information about how much the executives are making from the previous quarter or the previous fiscal year. Publicly traded companies, which is every company that is listed on a major exchange, they are all publicly traded. We are the public. We can buy and trade those shares. They are required by the Securities and Exchange Commission to publish earnings in the form of 2 types of reports, 10-Ks and 10-Qs. 10-Qs are quarterly reports that are published after quarter 1, 2, and 3. Each of these quarters is 3 months, so after the first 3 months of their business cycle, they give us the first 10-Q, then another period goes by, another 10-Q, another period goes by, another 10-Q, then finally, after the last 3 months, we get a 10-K. So the 10-K is published annually and includes quarters 4 as well as 1, 2, and 3 in the entire year's performance. These earnings reports mostly follow the same kind of structure. They usually offer the exact same information, but with the company's numbers and a little bit of the company fluff thrown in there. So the structure is this. Usually these earnings reports will open up with a letter to the shareholders. Hello and welcome to our earnings report. This is going to detail our earnings from this period to this period for this company. We are pleased to bring you this report. It's all of the wordy stuff that is not so much substance as it is just an introduction. Then we have their net revenue. This is where we start getting into the real numbers and the important parts of the earnings report. Net revenue is their sales minus the cost of those sales. So if they made a pair of shoes that sold for $50 and it cost them $5 to make the shoes, then their net revenue would be $45 for that pair of shoes. The next is gross profit. This is the net revenue, so sales minus goods sold, cost of goods sold. But now we take away the operating expenses. How much did it cost them to research that pair of shoes? How much did it cost them to ship that pair of shoes? How much did it cost them to advertise that pair of shoes? It's all of the other costs that go into the price of that pair of shoes. Then we have our net income and earnings. This is, if you don't want to think about all these crazy balance sheet numbers or their cash flow here, just look at earnings. Earnings is how much profit minus their other income, expenses, and taxes. So companies have to pay taxes. Companies need to pay interest on loans or on money borrowed. So all of that is going to go into this number, which finally brings us to the number that, as investors, we are most likely to look at and is one of the most important figures from this entire earnings report, the earnings per share. EPS, or earnings per share, is the amount of earnings they made divided by the number of shares outstanding. Remember, we have two types of shares. Shares float, which is the amount of shares that exist for retail investors like you and me to actually go out and buy. Then there are shares outstanding, which is all of the shares that exist. Not all of those are shares we can trade. Some are owned by institutions, some are owned by the people within the company. So earnings per share is every share, inside or outside, and taking the number of earnings, how much money the company made, and dividing it by the shares outstanding, which gives us a number. That number is very, very, very valuable to us because it allows us to see what's their profit. What is their profit per share? Some companies might have a very, very high EPS. Others might have a very, very low EPS. And a low EPS is not really a bad thing. It just means that their money isn't coming out as profits, could be going elsewhere, or it could be reinvested back into the company itself. There's nothing wrong with that. So the most important thing is not the earnings per share number, but instead we care about growth. We care that the company is growing, which is why when we look at earnings per share, the real value is not the raw earnings per share number. It's the earnings per share growth. For those that are familiar with Be a Profit, we have B and then E. The E stands for earnings per share growth quarter over quarter. That is the gold mine in there. So when it comes to our earnings reports, one of the most important parts that we can take away from it and what investors will tend to look at is the EPS figure. How much profit did the company make and how much profit will each share get? Then the last one is dividends. Many of us are familiar with dividends, and these are just when there's a lot of money left over at the end of the year. Some companies like to reward shareholders. So what they will do is they will provide dividends. little bits of here, bonus cash that is given out on either a quarterly or annual basis. And that's a topic for a different day. In fact, it's a topic for a couple months ago. If you're interested to learn more about dividends, we do have an entire webinar on dividends talking about what they are, the different dates that are involved in a dividend, as well as what the dividend aristocrats are. The best of the best when it comes to providing you with consistent and increasing dividend payments. But now, let's go back and let's focus on earnings, and let's focus on the earnings side of all of this. Let's first talk about our quarterly earnings reports. These reports are filed with the Securities and Exchange Commission every quarter, and just as they're filed with the SEC, they're made available to the public. Now, these quarterly reports are not perfect, and I'm going to just show this next bullet point and then we'll talk about it. They're not audited. Auditing is a big, scary word for saying someone else looked at the numbers and said, I check here, everything is correct. It's a way for us to know that the company isn't pretending. They're not making numbers up. When it comes to that, you'll oftentimes hear the words cooking the books. It's a way of saying that the company is pretending that they're more profitable than they are, or that they're making more money, or that they are reporting less earnings so that they pay less taxes. All of those are not good. They misreport, and most importantly, they're false. So when it comes to finding the truth, an unaudited report always has a level of risk that it might not be correct. But that's not really true. When it comes to large companies, 99.9% of the time, it's going to be correct. That 0.1% is likely that it's just going to be an error or a mistake, not so much a cooking the books kind of situation. Quarterly reports, though, it is important to remember that they are unaudited. There is no secondary independent person that's signing off saying that this is all correct. Now, when do we get these reports? It's not like the quarter ends, boom, reports published. They have a certain period in which they have to provide us the reports. 10-Qs, quarterly reports, must be filed 40 to 45 days after the end of the quarter. For big companies, it's going to be 40 days. For the smaller companies, they get 45. These quarterly earnings reports are often released in addition to or right in the middle of what's called an earnings call, a conference call in which the management, the CEO, the CFO, the head of investor relations, and all of these really, really big, important people in the company speak to investors and, by extension, the public about the information in that report. Now, these quarterly reports give investors a lot of information, oftentimes a bit too much information about the financial status and the direction of the company. It's incredibly valuable for us to be able to get these reports because it allows us to get insight into the company, their profitability, their cash flow, their balance sheet. They have to show it all. And it gives us a pretty good idea of the real value of a company. More on that later, though. For right now, let's go into the yearly earnings. Will SMS go public? Probably not. Probably not going to go public. Now, yearly earnings are a bit different. because remember, we have our 10 Qs, and then after the fourth quarter, instead of giving us a fourth 10Q, they give us instead a 10K. These 10Ks are very similar to the 10Qs. They still have an earnings call, they still have the report that they file with the SEC, but with a few differences. One of the differences is that these annual reports are in a lot more detail, extreme levels of detail. But they also include things that the 10Qs don't, such as information about properties that they own, different staff numbers, so how many employees do they have, where are the employees, what are they spending on utilities, what are they spending on research and development. It's a breakdown of every dollar and cent that's gone into or out of the company. In addition, they give us information on how much the executives are making. Those big people that sit above the board and make all the decisions, yeah, we get to know how much they're getting paid from the company. So the other difference here is that 10Ks are audited. There are independent auditors that will review the financials of the company and make sure that there's no, for the lack of a better term, bunny business. Their earnings are correct, their cash flow is accounted for, everything is as it should be, people are getting paid the correct amount, and the tank is clean. That is what goes into a 10K. Now, there's a few extra steps here. There's a little bit more involvement really in getting these reports done. So they get a little bit more time. The bigger the company, the less time they get. You would think it's backwards, but no. The bigger the company, the shorter time they actually get to produce the report. Anything above $700 million is going to get 60 days. If you are between 75 million and 700 million, you get 75 days. Anything smaller than that gets 90 days. Again, that is the amount of time you have from the end of your quarter, your fiscal year and quarter, to when you have to produce that report. I've used this word, fiscal, quite a few times. So let me just quickly go in and let's talk about what that actually is. So fiscal is going to be a type of calendar, let's say. What it is when we look at dates, months, quarters, it really relies on a calendar year. So we can say, for example, quarter one is January to March. Quarter two is April to June. Quarter three is July to September. And quarter four is October to December. So these are our calendar quarters. Falls in line a little bit with the seasons, but a little bit less like the seasons. But you can think about it like that. They are 3-month periods that rotate in and out, and that is how the calendar works. A fiscal calendar is a little bit different because our quarter one starts on January 1st and ends on March 31st. A company gets to decide when their January 1st is. So what that allows them to do is say our company's new year is on September 24th. By the way, today is September 24th. Happy birthday, Nate. So January 1st is whatever day they decide it to be. It can be September 24th. It could be April 12th. Doesn't matter. It can't be February 30th, though. That one they're not allowed to have. But what this allows them to do is it changes the due dates of their 3 10Qs and their 10K report. This is extremely useful for some companies that don't work on a calendar basis, that they work very seasonally or whatever it might be. They get to decide when their fiscal year starts and ends, and the cat is going crazy. I mean, the SEC respects that. So that is a fiscal year. It is when does the company want to start and end their accounting year. But it's also the reason that companies have different reporting dates. It's not just they have different deadlines. Because fiscal years exist, it's the reason that not all companies release earnings on the same day or the same week. Now, many companies, and I would say the majority of companies, still use calendar years for their reporting and accounting. But others do use fiscal years. So because of this, there are always earnings reports that are coming out, and those earnings reports are going to be spread out because not every company will have the same fiscal start and end periods. But one thing is for sure, there is always a big bump in earnings after the end of each calendar quarter and calendar year. So let's go into this a little bit and talk about how to actually track earnings calls. Earnings dates are extremely easy to track because we have deadlines and those deadlines need to be met. And those deadlines are not set by the company, they're set by the SEC. The SEC doesn't play around. So it's very easy for us to know when we can expect earnings to be coming up. There are various companies that offer lists or what are called earnings calendars that talk about when all of these earnings are coming out. So 3 of the ones that I look at pretty often, and I'm just going to reference here, these aren't the only ones, but these are 3 that I use. I use Zacks probably the most. It's a great earnings calendar that offers us not just the ability to see earnings dates, but also earnings revisions, also dividend dates, stock split dates, and more. Finance Yahoo is a really easy view. It's super user-friendly, and it's a great, easy way that if you don't want a bunch of other stuff, you just want to know who has earnings and when, Finance Yahoo. And Business Insider is a little bit of a middle ground. It's a little bit more information than Finance Yahoo, a little bit less information than Zacks. And again, some of these calendars will give us more than just earnings because it will help us to track dividend dates, dividend X dates, payment dates, stock splits, when these splits are occurring, and more. But if all you care about is looking at when does one stock have its earnings, FinViz is going to be your best bet. I want to go over really quickly to FinViz, and I want to show you all this. So, if someone can, please give me a ticker symbol. What ticker symbol do we want to see? What's a ticker symbol that we want to see when the earnings are? All right, Tesla, let's go. Let's do it. So, right here, there is the earnings date. So their earnings, the most recent earnings date was on July 26th. Let's go see PLTR. Their earnings were August 12th. Apple, July 27th. Zoom, August 30th. NIO, August 11th. Now, Everyone's pretty familiar with FinViz and all of the awesome information that it offers. What if I told you that where most of these numbers come from is the earnings reports? Many of these numbers, including EPS, P&E, well, P&E is kind of based on it, but not really, insider trading, or insider ownership, return on equity, return on investment, all of these figures that we get from FinViz come from these annual and quarterly reports. So these reports are the reason that websites like FinViz offer us so much information about stocks and what the fundamentals of the stock are. That is the real value here, is it allows for fundamental analysis and fundamental investing. So now that we've talked a little bit about what earnings calls are and how to track them, let's now talk about joining them? Can we? Yeah. As investors and as people of the public, we have access to company earnings calls for publicly traded companies. I will tell you right now, I've sat through some in the past. They are boring, they're repetitive, they follow the same format, and guess what? They have their very standard responses. There's a very, very funny Key and Peele skit where sports people, whenever they're asked about the game that they just played in, they're going to have the same very generic responses. The opponent team played very well. It was a heated match, but we ended up coming out on top because we had the will and the desire to win. How many times have you heard a sports figure say that as the answer to, what did you think of your performance today? Does that answer the question? No. But it's their script and they can go along with it because it's easy. These investment calls are very, very similar. Earnings calls will follow that very same script. This was a challenging year because it was an unprecedented time for us all, but we managed to sustain our sales and our earnings through the year and come out the other side stronger and more unified. Things like that. You learn to cut through the fluff and you can get some decent information out of it. But the reason I'm saying this is not because I think it's valuable to go sit through every single earnings call. In fact, you're better off using that to fall asleep than you are to learn something. But it is incredibly valuable if you are a shareholder in that company. Most shares offer you what the ability is to vote. So many shares are voting shares and give you the ability to vote in company decisions. Because of that, understanding more about the company's leadership, understanding more about the board, and understanding more about the company structure is very, 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 very valuable when it comes to making an informed and correct decision. You have a say in the actual company. Because of that, it's important for you to go into it well informed. And these calls will offer you a lot of valuable information when it comes to making that investment decision. There is a question here. How far in advance do you have to be an owner to receive dividends? Is it different for each company? So there are multiple dates that are involved in dividends. There is the dividend payment date, which is when the money actually goes out. But there's also the dividend EX date or X date, which is the date at which the cutoff is, where anything after that, if you buy the share, you don't get the dividends. Whoever owned the share on that date gets it. But again, for more information on exactly what all of the different dividend dates are, because there's 4 big ones, I recommend taking a look at the dividends webinar. Let me see if I can find it. Here you go. Dividend webinar. There you go. Jose is asking an amazing question. What is the easiest way to see the 10Q reports for a company? SEC. The SEC website. They have, I forget what it's called. It's like Oscar or Edgar. There we go. Edgar. So if you go to here, Edgar. You can put in a ticker symbol for a company and get all of their filings. So there's all their 10Ks and some basic company information and things like that. So this is where you get a lot of that information from, is going to be from the SEC's actual website. However, many other companies will also have different tabs on their website. So like, let's go to AMC's website and see if we can find, where is it going to be? No, thank you. Get out of my way. So it's going to likely be under Investor Relations. Investor Relations is going to have, oh, hey, look, right here is the link to AMC's most recent investors call from Monday, August 9th. So you can join the earnings call from there, as well as you can see other stuff such as their annual report. By the way, they're very, very long. So definitely not a light read. But investor relations sections of, here's their second quarter 2021 results. Investor relations, or sometimes investment resources, those sections of the websites are going to have that kind of information. A website, for example, like Tesla is going to be a little bit more challenging to find, but even then, we can still find it under investment relations. And here are their 10Ks, and then Q4 is going to be their 10Q. Here are their 10Qs, and then the annual is going to be quarter 4, which we see as a 10K. And here you go. Here are their actual, yeah, you usually need to give this, but here are their actual earnings calls. You can join in and you can listen to the conference call where Elon Musk likely is talking to all of the shareholders and all of the investors and all of the board members and all of the media outlets that are watching and listening. Also, they offer the ability to have question and answer, where shareholders and board members can ask questions for the executive leaders to answer. These can be mixed results. Sometimes you get some amazing information out of them, and I've seen some earnings calls that go south because, again, they follow a script. They follow a very neat path. When a question knocks them sideways, sometimes they have a little bit of a hard time veering back on course. So where can you find information on 10Ks and 10Qs? SEC.gov's website via Edgar, or the investor relations section of most publicly traded companies' websites. Alrighty then. Now, I've told you a lot more about earnings and what earnings calls are and why they're one of the best bedtime stories that you could ever listen to because they put you to sleep in minutes. Now, why should we care? Because if I'm just telling you they're boring, they're long, they're not worth reading, why did I make a 1 hour long webinar about them, right? It's because I had to. No, I'm kidding. It's because earnings are incredibly valuable. It is one of the only ways that we get to really see and understand the full profitability and cash flow of a company. Profitability is how much money they can make, how much extra money after they've paid out everyone, they've given out their dividends, what's their extra. Cash flow is they get money in, that money goes out. Where does it come in from? Where does it go out to? That is cash flow. understanding that gives us a lot of insight into what a company does. For an example, for the first couple of years of its operation, funny enough until 2018 if I remember correctly, Tesla didn't make a single penny of profit. They lost money every year consistently. Why? They were one of the largest growing automotive companies. They were a huge company, had recently been listed to the S&P. They were massive. Why had they never turned a profit? It's because every cent that they made and more went straight back into research and development and production for the company. That's why it's incredibly important to not just look at the one or two figures that we get given, and that we understand a lot more about what goes into a company's real value, why earnings per share growth is important, and understanding the cash flow is valuable. Because when it comes to the value of a company, there's really two main parts that we can look at here. And, I want to talk about those two parts because they work together when we're looking at investments. One is, what's the price you're willing to pay? Many of us will look at a company and say, too rich for me, don't feel like it. While others were looking at it and saying, hey, honey, look at the stock. It's cheap, let's buy some. That is the price. The price is what is the market willing to pay for a share of that company. That price is completely independent of the actual value the company has from its earnings. If you're looking at earnings per share, or EPS, and then we're looking at the price per share, we can get rid of the per share part and just compare the price that the market is willing to pay for it compared to the earnings, the actual value of that share in the company. And if we stick these two together, we get a very important gauge of the value of a company. Price to earnings. Price to earnings, or P/E, is a type of ratio where it is 2 to 1, 3 to 1, 4 to 1, whatever it might be. It compares the price per share of a company to the earnings per share of the company, or earnings divided by number of shares outstanding is what earnings per share is. This P/E ratio is incredibly valuable for us because it allows us to compare the price investors are willing to pay for a stock against the actual earnings value per share of that company. A high P/E means that the price per dollar of earnings is really, really high. And this might seem like a bad thing. You're paying more for less value. But that's not always a bad thing, because sometimes we don't mind paying a little bit extra if that means that we get a higher quality stock. It's weird because we're geared to think we want to find the best deal we can. It's why we like finding stores that have the discount rack, or my favorite place in the world to go shopping is Nordstrom Rack. You get a lot of cool stuff for pretty cheap, value-wise. They're decent clothes, and the price is very, very low compared to what you would spend at a normal Nordstrom, or Saks Fifth Ave, or whatever it might be. Now, when it comes to stocks, it's a little bit different. For stocks, even for clothes, sometimes you don't mind paying $100 for that jacket because it's a very high quality jacket. You know it's going to be great for years. You can wear it in all different occasions. It's a good value. Yeah, you're paying a lot more for it, but you'll get a lot more value out of it. It's worth the extra money. The same thing can be true for stocks. On a completely unrelated note, let's look at some examples. Romulo's asking, what I want to know is the next day of the earnings call, the price of the share goes down or up. I will talk about that. Do not worry about that. I've got plenty of slides to talk about why and how earnings reports affect the market and the stock price. So bear with me. If I don't answer your question exactly, feel free to ask me again, and I will definitely go through in some more detail. So let's actually look at a few examples for price to earnings. Let's take Apple. Apple currently has a P/E ratio of 28.77. So for every $1 of earnings that Apple has, you have to pay $28.77. That doesn't seem like a very good deal. You're spending a lot of money for not a lot of value, right? Kinda. The value I'm not going to touch on. That is not something that a single person can actually say. But we can compare it to the sector. The sector is going to have an average P/E. Take all of the companies and stick them together and find the average price to earnings ratio. The average in technology is currently 27.76. Now, P/Es can be very, very low. For example, Joanne, the fabric store, has a P/E of 1.96. That's not bad. It's impossible really to say if a P/E is good or bad. It's subjective. It's what do you think it's really worth. You might think it's a good deal, or you might think it's a bad deal. It's all an opinion. There's no... If a person tells you that the P/E for this company is terrible, they're probably not giving you the best information. No one can tell you the best information because the market price is what the market thinks it's worth. So the market is going to tell you what the P/E should be, quote unquote. And that's reflected in these numbers that we're looking at here. So, is Apple a bad deal? It's a little bit more expensive than the average in technology, but it's still better than GameStop was in January, where it hit a P/E of 310. So, yeah, P/Es can be very small, very big, or can even be negative. If a company's earnings was negative, its P/E can be negative as well. So that's where things get really interesting. Keep in mind, the only time price changes every second, all right? The fact that I wrote 28.77 here and 27.76, the market, there's after hours trading, and I'm willing to bet that that P/E is already changed. And I made this presentation not too long ago. Prices change every second, every millisecond. Earnings don't. Earnings only change 4 times a year. Quarter 1, quarter 2, quarter 3, and annual. So is that to say that the only time and the only way that earnings changes is when the price, when P/E changes is when the price changes? Yes and no. Yes, the earnings part of price to earnings only changes 4 times a year. But the market doesn't wait for earnings. The market price changes daily, and they don't wait to see what earnings reports are to decide whether or not to buy or sell, and at what price to make those trades. There are people that are called investors, like you, me, and Juan de los Palotes, and then there are analysts. Analysts have the job of looking at data, looking at all sorts of things to try and say, what do we think the earnings are going to be? Because, again, it's not like it's here, 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 do report, okay, and then here, 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 here. The earnings are always changing. Companies are always making and losing money. And the market reflects that. The market knows, kind of has a good idea of what's going on. And the current market price for a stock often is reflective and includes what the market thinks a stock's earnings will be. Sometimes the analysts are right. Other times they are very, very, very wrong. I'm just going to make an analogy here. I think I've said this before, one of the best jobs you can have, for job security that is a weatherman. You can get the weather forecast completely wrong and still have a job the next day. For analysts, it's kind of true as well. Analysts try and forecast not the weather, but earnings. So to look at the earnings, they're going to do a number of different things that people like you and me could do, but don't have the time, resources, or drive to really do. They're going to look at the economy of the globe, the economy of the country, of the company, market atmosphere, and even go so far as to ask customers, hey, did you buy that new iPhone? What do you think of that new iPhone? Are you going to buy that new iPhone? Or the suppliers, how many microchips did you sell Apple this year? Checking to see the revenue of different companies. Remember, fiscal years are completely different for different companies. So the supplier for microchips for Apple may have already published their quarterly report that says we sold $5 billion worth of microchips. Good guess is most of that probably went to Apple. So we can guess what their cost of goods bought were, what their goods and inventory bought were based on the earnings and the cash flow of their suppliers. There's many ways for us to be able to figure out what the current earnings of a company is, including what did they do last quarter. Remember, all of this picks up somewhere, and it picks up where they last left off. So an analyst is going to take in all of this, do a little brrr on the computer, and then ching gives them an earnings estimate. This earnings estimate is going to cover the earnings and profitability of the company. It's going to be a guess, and not all the guesses are the same. So when it comes to looking up, all right, all of you, what's the forecast? What do you all think? All of the analysts are going to all scream at once what they think it's going to be. And poor Google or Yahoo Finance is going to sit there and say, okay, the average is this. And the average is called the consensus estimate. Now, to the question from before. How do forecasts, and by extension, how do earnings reports affect prices? Well, analyst estimates are constantly changing because every day we get more information, and as earning calls get closer and closer and closer, investors, it's kind of a little bit of gambling, right? They start to bet as to what they think the company is going to do. So let's use the example of betting on a sports game in Vegas. There is going to be the line, and it's a random point where we can say the Juan de los Palotes Chargers are playing the Maria de las Flores Rams. And we can say the Chargers are favored, so the Chargers we think are going to win by 5 points. So instead of betting that the Chargers are going to beat the Rams, instead we bet, are the Rams going to do better than 5 points or worse? So the line is not who's winning or losing, it's are we above or below the estimate, that consensus estimate. Are we above or below that? And people bet to see if the results are going to be above or below that line. As earnings get closer and closer and closer, more and more people start betting, buying options, leveraging or hedging their bets, trying to see how much risk is there and how much reward, and trying to figure all of that out. So volatility for the stock goes up. Prior to an earnings report, volatility for stocks tends to go up as people start to speculate and invest into whatever they think the result's going to be. Now, close. We have the earnings call. Earnings call comes out. Report comes out. Suddenly, we now know the real numbers. Investors immediately go and compare the consensus estimate against the real numbers. And what this is going to do is it's going to tell us, did the real numbers beat or get beaten by the estimate? And these differences between the forecasts and between reality will affect prices in the short term. Where if a company falls short of their estimates, they didn't reach what the analysts thought they would, the price is typically going to go down. Remember, those analyst estimates are based on the market and are based on the price. So if we see that the price is trading thinking that it's worth whatever the analyst or whatever the consensus estimate is, and they don't reach that, all of a sudden, wait, why are we paying so much for this company? They didn't do as well as we thought they were going to. People dump. Or if the company exceeds estimates, the price is typically going to go up because we thought that we knew what was going to happen, and all of a sudden they did so much better. So the company is better than we thought it was going to be. A lot of people want to buy in. But there's something to remember here, and this is one of the most important things to remember when it comes to earnings. When earnings are released, for the 10Qs, the information's already 40 days old. It's a month and 10 days old. When we get the annuals, it's already 2 months old. We are already further into the next quarter. There's less time left in the next quarter than there is time that's passed. So it's old. It's slightly stale data. And because of that, it's almost like yesterday's news. So why does it matter? Why do we care? Why am I talking about all of this if it's old? Because while it's older information, while it's yesterday's news or last month's news as it is today's prices. The market does tend to react immediately to the results of an earnings report, where as people settle where things fall, if the results are positive, things tend to settle a bit above. Yeah, they're going to have a spike and then a little bit of consolidation, but really, a lot of this is just going to have a slightly above or slightly below level. The analyst estimate and how far we are away from that is going to affect things mostly in the short term. It will have a more long-term effect, but that's not because of the estimates. That's just because the company is improving or losing strength, and that's normal. Earnings just give us numbers to back up or confirm or even deny what we might think is going on. So now, to the takeaways. What should you know moving forward past this webinar? Earnings calls are an inevitable and important part of the investment world, and the investment cycle. 4 times a year, we get information from the company's leadership about the profits, losses, and just more information about the company's money and management decisions. There are people that are the weathermen of the financial world who create forecasts on what they think a company's earnings will be, and then investors bet on which side of the estimate the real results will fall. Now, the difference between the estimates and reality is pretty commonly there. There's usually going to be a difference. And that difference will result in short-term dips or spikes in price, but also will result in smaller long-term shifts where if the results are positive, the price is going to end up a little bit higher than it was before, most likely. If the estimates were above the reality, if reality failed to meet what they thought it was going to do, things are probably going to go down a little bit. It's going to dip down first and then settle out, but a little bit lower than it was before. And then the last thing is why we should care. Whenever we invest into a stock, whether we like it or not, there will be 4 earnings calls a year, and those 4 earnings calls will impact the value of that stock. Understanding when these earnings reports are coming up will allow us to prepare for any changes in price, but also give us something to expect, where we know if there's a dip or spike in price, it's not some random event, it's due to earnings. It also allows us to get new information for fundamental analysis, for things like Be a Profit. A lot of new information comes out when we get those earnings reports. But they're also an amazing way for us to get involved. Keep in mind, when you're buying a share of a company, you're not just buying a commodity. You're not just buying something so you can sell it later. You are now a part owner in a company. And because of that, you likely have a say in important company decisions that company makes. So following these earnings calls is an amazing way for you to get involved with the company, understand more about the company and their leadership and their direction and their goals, so that when and if you choose to vote, you go into it knowing a little bit more about what is the best decision for the company. And the last point is this. Following earnings calendars will give us an idea of when to expect significant numbers of earnings, mostly at once, because these will have a larger impact on broader indices and sectors. Keep in mind that a sector is a group of companies. An index is an even bigger group of companies. When a lot of earnings reports all happen at once, we're very likely to see changes in that sector or in that index. So understanding when those big earnings periods are happening will prepare us for those changes. The upcoming one to expect is going to be let's see. We're going to have a lot of earnings coming out in mid-October and then even more in November. So stay tuned for those, because that is when we're really going to get to see what earnings periods look like. We will be keeping up with them in Sectors Made Simple's newsletters. So under the What to Watch For, when we have heavy earnings periods, you'll see me say, all right, and this week, expect this, and this companies to have earnings reports on this, and this day. Because whether we like it or not, companies make up a sector. So understanding more about the earnings of a company is very, very important, as they impact the price both short-term and long-term. Do I follow the earnings calls of companies I invest in? Yes. I will usually track a earnings date. Mostly I'll look at the earnings date where I won't invest if the earnings date is very, very close to when I'm buying, simply because things get a little bit more speculative around earnings periods. I tend to wait for earnings to come out, a week for everyone to settle down after the results before I buy in for a more mid to long term investment. But for more information on that, I'm sure that my mom would have much more, wouldn't say, she would have a lot more knowledge as to what broader, like, what broader information you could get from that. Because, again, looking at a single company, it's going to really be hit or miss. Because companies like Tesla, for example, oftentimes are super far away from their earnings. They'll either super outperform or super underperform. Whereas other larger, more value companies, they're likely to be very, very close to analyst estimates. So it really depends on the type of company and if their growth or value as to how much of an impact those earnings would have, because it determines how far off could investors be, or could analysts be, really. So that is all the time we have for today, everyone. Thank you all so much for joining us for another very informational and interesting webinar. I hope everyone learned something new today and helped strengthen your knowledge as to why sector investing can be made simpler by understanding more about the market as a whole. If you have any questions, please send us an email at support@sectorsmadesimple.com. It's amazing to get to hear from you all, your successes, your lessons learned, as well as topics that you would like to hear us talk about in an upcoming webinar. So, until next Friday, thank you all so much for joining us, and we'll see you all very, very soon. Take care. Have a great weekend. Bye.